What is good, family? Welcome back to Horizon Market Moves, where we are building legacy one trade at a time. Today, we are getting into the infamous fair value gap. It is extremely important. It is a major part of the strategy, and I'm excited to finally get to this point. We are getting closer and closer to actually implementing the strategy and then putting it into use. So let's get straight into it. So today we are diving into fair value gaps. What I call fair value gaps is the market showing its hand. All right. When you understand fair value gaps, you see where price rushed and left unfinished business. That insight transforms your entries from guessing into high probability sniper style trades. So let's get into that. So as you can see on the screen, I got some things lined up. We got a bearish full of fair value gap, and we got a bullish fair value gap. We will also be talking about inversion fair value gaps, bullish and bearish. So let me go into the analogy for you. I like to use the bricklayer analogy. So imagine a bricklayer building a wall row by row. He should place each brick very carefully, ensuring that it fits snugly. But sometimes the bricklayer moves too quickly. He skips a spot or leaves a space in between the bricks. From afar, the wall may look okay, but up close, there's an obvious hole. The builder must come back later to fill that gap. Otherwise, the structure is weak. And in the market, a fair value gap is that missing brick or that missing space. Price moves so aggressively that it skips over a zone where buyers and sellers didn't fully interact. The algorithm recognizes that hole and often returns to fill it before continuing. Understanding this is like knowing the bricklayer always comes back to finish the job before moving on. All right. A fair value gap forms when three consecutive candles align, but candle 3 does not overlap the body of candle 1 after a strong move in candle 2. In a bullish fair value gap, candle 2 pushes up sharply and candle 3's low remains above candle 1's high, leaving a gap. Now, in a bearish fair value gap, candle 2 pushes down sharply and candle 3's high remains below candle 1's low. The empty zone between the unoverlapped areas is the imbalance, also known as a fair value gap. This imbalance signals that price moved too fast for fair exchange. Buyers or sellers in that zone didn't get a chance to participate fully. Smart money often revisits that gap to rebalance orders, like the bricklayer returning to fill in the missing spot or a missing brick. All right, so let's get into the chart. Let's get into my drawings, actually, and then we can further explain this. So here we have a bearish fair value gap. This is candle 1, this is candle 2, and this is candle 3. As you can see, candle 1's wick does not overlap into candle 3's wick or body. And when we have that, this is how we measure the gap. You get you a rectangle box, you stretch it from that wick to this wick, and if it makes a space, that's the gap. You can also notate it by doing this right here. Once you make the rectangle, your tool settings will pop up here. You get settings, write your text, fair value gap, you write that in there. Then you go down to template and you hit save as, and they'll ask you what you want to save it as. I saved mine as FVG. So when I click that, just hit OK, and that's what it is. So as price is moving down, at some point, price will return back to the fair value gap before moving back to continue the pattern. Okay. So let's get into the bullish fair value gap. We have candle 1, candle 2, and candle 3. Candle 1's wick here does not run into candle 3's low right here. And let's measure that out once again with the rectangle tool. And this is the imbalance or the fair value gap. Like I said before, price will then at some point return to this fair value gap to continue flow here. So price would do like this at some point and continue up. On here, price would do like this right here at some point and continue down. Okay. So that is how you mark out a fair value gap. So why do fair value gaps matter? Fair value gaps matter because they reveal where the market was rushed. They act as magnets for price returning. When price comes back to a fair value gap, it often reacts, either bouncing or filling it completely, then continues the main trend. That reaction gives us an edge. We can anticipate where price might pause or reverse, and we can plan entries with defined risk. Moreover, in smart money trading, recognizing a fair value gap shows you the algorithm's footprint or hand. It's evidence of aggressive order flow. If you trade around these zones with proper context, you avoid random entries and align with the market's own corrections. All right. Now let's go on a chart and let's start marking some out and seeing how price returns back to it. This is the zone that we will be working in for this example. Y'all can pause the video and identify the gap on your own to see if you guys are catching on. All right. So I never pause the video, right? It's like, no, I'm tripping. So here's candle 1, here's candle 2, and here's candle 3. I like to use the snap tool because it'll get it right on there for me. Boom, boom, stretch it across. Mind you, this is a 4-hour time frame, but look how powerful that is. Price eventually comes back to this fair value gap and has a very strong reaction off of it. Okay, very strong reaction. Now, I know you might be wondering why we didn't mark up this one. You can mark up this one too. But you need to wait for some kind of signal saying that this is where price wants to turn around. Okay. You don't just blindly enter into a fair value gap. Okay. And we'll talk about that as we move on. But right now, let's just identify some more gaps. Here we go. We got another one here. Came back, and actually this is where we at in time right now. But it came back here, reacted. This is a big move on a 4-hour, and it came back again to react off of it. Let's look at some bearish fair value gaps. This one here, bearish fair value gap. Candle 1, candle 2, and candle 3. Candle 1's wick did not touch into candle 3's wick, and which left this space right here. Okay. Price reacted off of it and came down, came back into it, reacted again. All right. Now let's move on. Now let's talk about context and filters. All right. Not every gap merits trading it. Okay. So you have to, so number one, higher time frame bias is very important. So before focusing on the fair value gap, confirm your bias on the 4-hour or daily chart. If your daily structure is bullish, prioritize bullish fair value gaps formed in a retracement. If bearish, focus on bearish fair value gaps and a pullback. Okay. Meaning, if we are bullish here, we are going to be focusing on bullish fair value gaps, not bearish fair value gaps. Okay. So we'll be marking up any kind of fair value gaps that's giving us bullish activity, like this one here. That was a beautiful reaction off the 50% encroachment. The 50% encroachment is just the halfway mark of the fair value gap in question. Okay, so like where we identified if we were bullish, right? We wouldn't go here and mark up a bearish fair value gap, thinking that price is going to respect it if we are bullish. Okay, that's what I mean by context. All right, so what's going to happen is going to bust through, and you're going to lose your trade and be upset, wondering why. All right. All right. Number 2, liquidity and structure break. Ideally, a fair value gaps form after liquidity sweep or break of market structure. That tells you the move had momentum and the gap is significant. Now, when we're talking about our strategy, we're looking for a liquidity sweep, displacement, and then a fair value gap. That's what I mean by that. That's when that fair value gap means a lot to us, and that's when we are specifically looking for it. Now, you could be looking for a fair value gap for a continuation after that move as well, but you have to have a confluence, like a bullish engulfing if we're going if we're bullish, or bearish engulfing if we are bearish. Okay. Let's talk about partial fills versus full fills. Sometimes price partially enters a gap, tags the edge, and reverses. Recognize this as still a valid reaction if confirmation appears. Other times it fully fills, then reacts. Both can work. Understand which happened, okay? Multiple fair value gaps in sequence. In strong trends, multiple fair value gaps can form in succession. You can mark each and look for cascading entries or multiple legs, entering each time price returns to a gap. All right, so let's talk about false returns. Occasionally, price fakes a return into a fair value gap, but then ignores it. This signals strength in trend or a deeper liquidity hunt. Learn to recognize when to stand aside. We just talked about that. You need some kind of confirmation, some kind of confluence. All right, combining with liquidity concepts. If a fair value gap lies within a larger liquidity zone, such as the previous day high or low, the confluence zone carries extra weight. Always map external liquidity alongside your fair value gap. And time of day matters, okay? A fair value gap form just before major news may behave differently. After news, price can gap fill more quickly or ignore minor gaps. Always check the news calendar when trading fair value gaps around high impact news events, okay? All right, let's talk about inversion fair value gaps. All right, what is an inversion fair value gap or an IFVG? So an inversion fair value gap occurs after a fair value gap forms and price later breaks through that gap, then retraces back into the same zone and respected as support or resistance. For a bullish IFVG, first a bullish fair value gap forms, then price closes above the gap, confirming momentum. Later, price returns into that zone from above, showing rejection or support there. This inverted gap now acts as a reliable entry for a bearish IFVG. Price breaks below a bearish fair value gap and then retraces up into that gap, which then offers resistance. An IFVG signals stronger conviction because price both rushed through and then affirm that zone on the return. All right. So let's go map out some of these. All right. So we already got one mapped out. So here we have a bearish fair value gap. Okay. Price instead broke through this fair value gap and we tested it right here with this wick. Let's break it down to a 15 so we can see that better. So look here. We don't got a gap here on the 15 to show, but it's going to 5. We should have one. This is an example of our inversion fair value gap. So here's the gap. Okay. Sorry, let me explain that. So candle 1, Candle 1, candle 2, and candle 3. Candle 1 did not run into candle 3, so we have this empty space right here, which we will call our gap. And what happens here is, let me squeeze it so you can see. Price went through, did not respect it, closed above. That is when we start looking for respect on this fair value gap, which turns it into an inversion fair value gap. As you can see, it broke through this gap and returned, acting as support. And then it continued up. That's what an inversion gap looks like. And that's a bearish inversion fair value gap. And now here we have our okay. And here we have our bullish inversion. As you can see, we have this space in between here, candle 1, 2, and 3. This candle did not intersect into the third candle. Price ran through it and is using this fair value gap as support to move higher. And it hit this zone multiple times before moving up. This could have been multiple entries if this is your model, but you have to trust your model or you would not be entering in this multiple times. You probably would get out of the trade if you saw this turnaround. You have to have trust and conviction in your model. All right. Before we get up out of here, let's talk about some common mistakes. All right. So common mistakes include making every tiny gap without bias or confluence. All right. Treating standard fair value gap as an inversion fair value gap before a true breach. Entering on mere touches with no reaction candle. Over trading small inversion fair value gaps without higher time frame support. Ignoring news context that can cause false breaches or erratic returns, and poor risk management by placing stops too tight or targeting unrealistic levels. Always apply our validation criteria: bias, structure break, clean gap, confluence, clear breach for IFEG, reaction confirmation, and acceptable risk to reward. If any criteria fails, skip and wait for a clear setup, because discipline beats impulse every time. All right. So this is our fair value gap video. Go through, mark up, make sure that you can identify fair value gaps. And I'll see you on the next one. Peace.